Anish Shah, Deputy Managing Director and Group CFO with Mahindra & Mahindra. Mr. Shah, good to have you back. Thank you for joining us. Last time when you were on the show, my first question was that why Mahindra Group of company stocks were underperforming. Well, 3 months is a long time because now all Mahindra Group of company stocks across categories have become massive outperformers, and in fact the stock of Mahindra & Mahindra is up nearly 100% from the recent low. So I'm sure you must be very satisfied with the way how markets are now reacting, acting and understanding what is happening to the rural economy and what is happening to your capital allocation plans.
Yes, we are very glad to see that. In fact, the stock is up 150% from the low of 245 that it hit in the middle of March. So we're very glad to see it, and we've always felt that there is significant strength in the Mahindra Group, and we can talk about some of that today. We're glad to see that some of our focus on capital allocation is playing out well as the rural strengths that we see augurs well for the company also.
Well, lots of follow-up questions for you. First, let's start with your understanding of what is happening to the rural demand. We can currently divide the business into two parts. The rural business, where margins for your farm equipment space are at an historic high, and then you've got the automotive business where there is a supply disruption, there is a demand destruction, fixed costs are high and margins are under pressure. So for the moment, we can easily divide your two businesses into two parts. One doing exceedingly well, the other one which is under stress.
Yes, that is the case. We are seeing rural India really propel the economy, and that's driven by a number of factors. Government spending is 26% higher than the prior year. 1.6 lakh crores has been transferred just since the start of the lockdown on March 24th. We're seeing a very good rainfall, which is 5% higher than the long-term average. The Rabi crop was a record crop at 150 million tons. The sowing of the Kharif crop has progressed very well, 106 million hectares till August 21st, which is up 10% from last year. So all of those have contributed to both rural incomes and sentiment. And we have therefore seen a very significant level of demand for tractors. On the auto side, we've seen good demand for commercial vehicles and a little less so for passenger vehicles, but that is picking up as well. And their rural demand has been much stronger than urban.
So the kind of demand uptick and margin expansion what we've seen in your rural stroke, the farm equipment business, is that here to stay, and can you have this kind of an commanding growth and uptick in margins for a sustainable period of time?
I would say that it's not about a significant uptick in margins. It's just that the farm equipment business is back to normal. We saw a reasonably good year last year. April was a total washout, and since April we've been able to catch up as such. So what we are seeing is in some ways reversal back to normal, and that's something that we do expect will continue.
Right. Mr. Shah, what is also exciting markets is your entire recalibration of your capital allocation strategy. Now, you've already gone on record and said that where do you want your return ratios to move. But before we revisit that, do you think individual group companies of Mahindra & Mahindra, whether it is your financial business or your technology business, or perhaps other businesses in real estate, will those individual companies be also adopting this kind of a capital allocation policy, or as of now this would be at Mahindra, the parent company level?
So first, it's all our businesses that make up the Mahindra Group and M&M. But let me give a broader perspective and then come back to your specific question. The broader perspective will be helpful in really addressing that question. So let's look back at 2002. M&M had gone through a fairly tough crisis at that point as well. And there was a very sharp focus on fiscal discipline. In fact, what we are saying today is identical to what Anand and the management team in 2002 put out for the group. There was a very strong focus on fiscal discipline, and that led to a 17-year run. What I mean by that is M&M was the best performing stock in Nifty from 2002, which is when the Nifty was set up, till August 2018. It was a 31% compounded annual growth. And that was driven by a 34% annual growth in EPS, a 22% average ROE, and strong cash generation, close to 2,400 crores a year on average. So we've been used to that. Our teams have been used to that fiscal discipline, and we're effectively getting back to it. We fell off a cliff from August 2018 till March 2020. Our stock went down 70%. A lot of it was due to our international subsidiaries. SsangYong in particular contributed a lot to the losses. They took away a lot of our profits over the last couple of years. And as a result of that, we've had to take action and take quick action on it. SsangYong, we've decided not to invest anymore. We've shut down Genzi, which is a US two-wheeler business, and that itself solves 80% of the problem. We're looking at every single loss-making international subsidiary now and looking at getting that back on the path to 18%. And this is something that is part of our DNA in a sense, in terms of creating that shareholder value. And therefore, it's not just the loss-making subsidiaries, it's all our entities that will contribute to it. And we can talk a little more in depth about Tech Mahindra and Mahindra Finance. They're very strong today. And we feel that they will continue to, in fact, add to our growth as well as our ROE, rather than detract from it.
Sure. In fact, Mr. Shah, I was just going to come to that, given that the focus is going to be on EPS growth, ROE, FCF going forward, and the fact that you're focusing more on the growth businesses. Take us through in a little bit more detail, how the strategy is shaping up on some of the names that you just mentioned.
So I would put our businesses in three categories, right? And this is what really drives what we call our Josh for growth. The three categories are: one, our core businesses, which we feel are very well positioned. Tractors and financial services tap into India's rural story. And we talked about tractors a bit earlier. Mahindra Finance also is a leading financial services provider in rural markets and is seeing very good collections, is on a very strong wicket at this point in time. And Mahindra Finance in the past as well has generated strong returns. And it's something that we expect it to continue generating strong returns as we see the future. Then we have SUVs, holidays, life spaces for the rising consumer. Commercial vehicles and logistics for e-commerce, and IT services that really is looking at technology to help transform businesses not only in India, but is in a leading position in various global markets. So that's the first set of our core businesses. The second is what we call our growth gems. These are 10 companies that we've identified right now. Each of them has a potential to be a billion-dollar company. Some examples are First Choice, which is an auto tech platform with physical and digital capabilities to buy or sell used cars. It's the simplest way to buy or sell used cars. And that is a platform that's not Mahindra specific, it's brand agnostic. And therefore, we see a lot of potential there. Excello is a company in steel services and solutions with a lead today in auto recycling. And as we expect the new recycling policy to come out shortly, we see a lot of benefits for Excello. They're very well positioned to take that growth wave and lead it. Susten is a leading solar company. Classic Legends has iconic brands like Java in India, PSA, which we will have for international markets in the premium motorcycle segment. And there are many others there. And then the third category is incubation for future growth. This is where we see long gestation businesses like aerospace, security solutions, healthcare services. So it's a good set of businesses. We've really had a very strong entrepreneurial spirit in the Mahindra Group, and that's what's helped fuel our 17-year run. And we have the seeds to do that again.
Absolutely, and clearly some of these businesses will also benefit from the Make in India push as well. The group, of course, is going to be front and center for that. Are there any challenges to the new strategy, Mr. Shah, as you look more towards execution in the new year in 2021, with regards to prioritizing, to making those choices as to which businesses to continue to focus on and which to avoid any fresh investments in and really power ahead? Do you foresee any challenges, immediately?
See, there are two parts to this. One is decisions to exit, and second is decisions to grow. The decisions to grow are easy. That's where the Josh comes in. That's where everyone's excited. The decisions to exit are the difficult ones. But recognize there that the toughest decision has been made already, and that was SsangYong. That's our largest international subsidiary, and that was a very tough call. But our board decided that that was the right call for the company. And having made that, and having seen that we have to go back to our roots in terms of capital allocation and fiscal discipline, we really don't see any problems taking tougher calls as we have to. We are focused on turning around many of our businesses. Some are well positioned in the markets, and we are seeing very good results from the work that we've done in turning them around. And some that may not turn around will exit. And that's part of our capital allocation discipline.
Okay, if everything goes as per your plan and what you've shared with us, what will happen to your return ratios? And how much of your existing loss-making business you will be able to exit, or you will be able to bring your ownership below 50%?
See, at this point in time, 80% of the losses that we had last year were taken care of by SsangYong and Gen Z. That we've acted on already. We have the remaining 20% of loss-making international subsidiaries to worry about. And that's something that we've got a very good plan in place. And in the next 12 to 18 months, we see most of those losses going away. What we have committed to the market also is by 31st March, we will have a clear plan that we announce for every single company. So that part will be taken care of. And then it's really being able to drive growth. And what we have at this point looked at is a path to 18% ROE for all our businesses, but we feel reasonably confident that we should be able to meet and exceed that.
How do you think your auto business, where market itself has been challenging and where your focus on SUVs is something which has worked for you? Sometimes, it does not work for you because of the cycle of SUVs. You will ensure that that becomes a stable part of your strategy.
Many have written us off at many points in time in the past. We came back with the Scorpio, we came back with the XUV 500, the Bolero has been a great brand. The Thar is out now, and that's something that we expect to do very well. We have 2 more launches coming up in the near future, and therefore we feel we are positioned well. We are really focused on our larger SUVs, which also blend well with our pickup trucks, typically the same platforms. On the pickup trucks, we have a 45% market share, and that's something that is extremely profitable for us as well. So if you were to look at pure market share for SUVs, that includes some of the smaller SUVs where we haven't been able to show as much success, but we feel that we are positioned well, and we feel that with some of these new launches coming up, we will regain a lot of the mojo that we've had in the past.
Can you share any initial numbers with us on Thar booking, and what is the update which you got from customers and dealers, just to get a sense as to what is happening to consumer demand, and are things normalizing in the automotive segment from a consumer standpoint?
The response has been terrific across the board. It's been an overwhelming positive. We've seen 5 million downloads to a particular YouTube video that we put out, and the messages coming back from everyone are just astounding. We are also seeing a lot of people signing up to take it even before we've announced it formally in terms of the pricing. The formal launch is expected on October 2nd. So all numbers will come after October 2nd. All I can say right now is it's created quite a buzz.
I had Mr. Vinod Dasari on our channel a few days ago, and he shared something very interesting. He said, look, Nikunj, we are now in a position to essentially do a complete end-to-end digital model, which is that customers are coming on our digital platform, they are booking a RE, and it is getting delivered. So there is no footfall or there is no retail experience. Do you think that also could happen now for cars and for some of the auto companies now, where because of COVID, a digital experience end-to-end will be implemented, and that is going to be a serious cost saving for auto companies who have to really dole out a lot of cash, capital and cost to run and create those car showrooms?
We have that in place already. We have what we call Own Online, and anyone who desires to buy a car can go on that platform and go through the very simple process and put down a deposit to get the car, which is then delivered to the person. We've started our digital initiatives about 5 years ago, and there's a number of steps that we've taken, not just in auto, but across all our businesses, and not just at the front end with consumers, but also at the back end. There's a lot of work being done on artificial intelligence in our manufacturing plants and our paint shops. And that has resulted in some very significant benefits for the company and helping us reduce costs and increase margins.
Okay, defense, Mr. Shah, let's talk about the opportunity there. It's a space that you've been looking at for some time, and now given the government's push, expecting to see a lot more action there. Outline for us perhaps how you are seeing this opportunity unfold.
There is significant opportunity in defense. It is going to be longer gestation. It will take time to start building a number of things that are now part of the 101 items that are Make in India. And Mahindra Group is well positioned. We have interest from a number of large players around the world who want to do more with us and partner with us. And we will see the space as it goes forward.
Okay. Also on engineering, where will you be able to extend your engineering capabilities as well? Are you looking at, for example, on the engineering front, expanding further, reducing imports as well going forward?
We do see our engineering strengths playing in a much bigger way. Today, our imports actually, at least in auto and farm, are low. If you're referring to the broader economy, we will look at opportunities, but we're also going to be very focused in terms of what makes sense. What we've done, as we spoke about earlier, is really tighten the capital allocation norms. So we're going to focus first on our businesses that have the growth potential that I talked about. And as new opportunities come up where we can leverage manufacturing strengths, we will do so, but in a very measured way.
That just brings me to a very broader question, that why were these capital allocation mistakes done? Mahindra Group understands the importance of capital allocation. Mahindra & Mahindra has really incubated a lot of businesses. I understand the ethos and the entire vision on which the group has been done. But between 2000 and 2010, or between 2000 and 2015, there are a lot of capital allocation mistakes which now can be pointed out.
So, Nikunj, the first is, if I were to go back to my earlier comments of Mahindra being the best performing stock till 2018, and it was not just at the stock market level, but also in terms of EPS growth, ROE and cash flow. Yes, there were a few things that, as we see today, haven't fully worked out, but there were a number of other things that worked out. The key for us is being able to move fast to address those issues, to be able to take hard calls. Also recognize that some of it is due to a lot of geopolitical issues as well, and economic issues in other markets. So we had a strong presence in Turkey, And we've seen what's happened in Turkey for the last 4 or 5 years. We've had a strong presence that SsangYong had in Russia, that Sampo had in Algeria. And these are some of the things that have contributed to what happened in those businesses. So it's a function of a variety of things. Not everything's going to work. We're going to try a number of different things, and what we've seen in our track record is a lot more has worked than what hasn't. But the key for us is being able to stay very focused and moving quickly if something doesn't work.
You've said the magical words which will excite every shareholder and investors. Focus on profit-making enterprise, cut down loss-making businesses, look at return allocation and return ratios. The extension to this, Mr. Shah, is a second part which could excite shareholders more. Focus on buyback, returning cash back to shareholders and increased dividend payout. So now your business does not need capital, we know it, because you don't raise capital, you've not raised capital. So if your return ratios will improve and if you are not going to be spending too much or splurging too much, can I assume that buybacks, dividend payouts, more cash back to the shareholders will also be considered?
Absolutely, because as we see more free cash, right, we are not going to get into this mode of here's free cash, let's go and do what we want with it. The capital allocation standards will apply. And therefore, on the earlier question, I said we will look at other manufacturing opportunities, but in a very measured way. And that will generate more free cash flow to be able to give back to our shareholders, because our focus is on growing shareholder value. And we will take the actions required for that. While I say that, I also want to emphasize the fact that from a Mahindra standpoint, our values extend to beyond shareholders. And communities are important for us, our employees are important for us, and that's everything that we will keep our focus on. That is one thing that does not change. As I talk about the change that we are seeing, that is a continuity that we will have. The focus on governance, the focus on our values.
And just to wrap it up with a very broader question, it's not the Mahindra Group, a lot of other corporate groups which had expanded themselves outside India, they acquired businesses, they set up subsidiaries, all of them are either looking at ramping them down or are looking at increased focus in the domestic market, which is India-centric. Am I right in my assessment by saying that now next 10 years corporate groups will be more inward-looking rather than outward-looking?
I would say that we're going to go where the opportunity lies. We're seeing India poised very well for rapid growth. The government is taking a lot of very good actions today. And as those actions see fruit, India is going to be in a space where we will see significant growth over the next 10 to 20 years. At the same time, the world's a tough place right now. So we will have to balance where we put our capital. I will also add that we do need to be global. We do need to make sure we can compete in global markets, because just being focused on India is not enough. If we can compete globally, we can be better in India. We need to ensure we have the technology that's cutting edge. So it's not about just being India-centric and staying here. We will continue to be global, but we'll be very careful in terms of where we put our capital and how we play globally. And therefore, that allows us to ramp up much faster in India.
Well, Mr. Shah, an absolute delight to have you back on ET Now. Thank you for sharing, rather openly and candidly what your view on the Mahindra Group is, where it is headed. Well, the stock markets, in a sense, giving a complete thumbs up to what our conversation today is. The stock is trading almost at the highest point of the day. So really appreciate your time.